Hey everyone, and welcome back to The Explainer, where we take raw, complicated financial data and break it down into something actually useful. Today, we're diving into a really fascinating mystery that's basically hiding in plain sight over at PJT Partners. See, on the surface, this company is a walking contradiction. If you look at one set of numbers, you'd think, wow, this is a wildly overpriced stock just waiting to crash. But then you peek under the hood at their actual operations, and it suddenly looks like one of the absolute best wealth compounding machines on the market. So, which is it? Are we looking at a classic value trap or a totally hidden gem? Let's figure it out.
Okay, let's just kick things off with a bit of a curveball. A question that really challenges a core rule of value investing. Is a stock with a price-to-earnings ratio of almost 29 ever actually considered cheap? I mean, conventional wisdom screams, no way. Usually, a multiple that high means the market is already priced in all the future growth, and literally any tiny misstep by the company is going to send the stock off a cliff. But judging a company based on a single multiple in a total vacuum, that's honestly one of the most dangerous things you can do as an investor.
Because before we completely write off that price tag, we have to look at the stock's pedigree. And man, these historical returns demand your attention. Just think about these numbers for a second. Over the last 3 years, it's returned nearly 151%. 5 years, almost 129%. And if you zoom all the way out to a 10-year time frame, you're looking at a jaw-dropping 636% total return. Right? This isn't some speculative flash-in-the-pan meme stock. This is a company that has proven it can be a massive winner over a really long horizon.
And it's not like it's just a slow, sleepy crawl to the top either. When we break it down year by year, you can see this growth is fueled by these massive, consistent spikes. I mean, look at 2020, a 67% return. Then 2023 gave investors another 40%. And 2024, boom, an explosive 56% return. When you see years of outperformance clustered together like this, it tells us the underlying business engine is incredibly adaptable and just knows how to capture upside no matter what the broader market is doing.
But this brings us to the elephant in the room. The past is great and all, but we're buying the future, right? If a stock has already gone on a 600% absolute tear over the last decade, you're probably thinking, have I completely missed the boat? Is it just too expensive now? To figure that out, we actually need to face some of those intimidating valuation metrics head-on.
So let's look at the bear case, because juxtaposing these two metrics paints a pretty scary picture. Honestly, if you were just casually screening stocks, you'd probably close the tab right here. You've got a PE ratio of nearly 29 on one hand and a price-to-book ratio of 12.35 on the other. A PB ratio over 12, that means you are paying 12 times the literal, on-paper accounting value of the company's assets. Traditionally, value investors start getting sweaty palms when a PB ratio just hits 3. So looking at these, it definitely feels like a stock priced for absolute perfection.
But wait, context is literally everything. Even with those sky-high multiples, the market has actually handed us a pretty massive discount lately. The last close price was around $156, but its 52-week high was way up at $195. That means the stock has pulled back basically 20% from its recent peak. A 20% haircut is a big deal. So the puzzle gets even deeper. Is this 20% drop the start of a massive crash because those multiples were just too crazy? Or is it actually a rare buying opportunity? Well, to solve that, we have to flip the script. Let's stop obsessing over how the market is pricing the stock today and start looking at how PJT actually runs its business. Because the plot twist here, it starts with what might literally be the most flawless balance sheet you'll ever see. 0. Yep, that is PJT Partners' debt-to-equity ratio. 0. We are in an era of super high interest rates where debt payments are just crushing the margins of normal companies, and PJT owes absolutely nothing. That means every single dollar of those massive 600% returns we talked about earlier generated entirely using their own cash. There's no leverage propping this up like a house of cards, which drastically lowers the actual risk of owning the business.
So the big question is, what are they actually doing with all that zero debt equity? They're compounding it at mind-blowing rates. Check out these efficiency metrics. A return on equity of over 58%, a return on invested capital of 44%, plus a healthy 10% net profit margin. I mean, a company generating a 44% return on invested capital without borrowing a single dime is just a powerhouse. It means for every dollar they pump back into the business, they are extracting an unbelievable amount of value.
And honestly, this brings us to the metric that completely destroys the narrative around that scary 28 PE ratio from earlier, the PEG ratio. If you're not familiar, the PE ratio just takes the PE and divides it by the company's earnings growth rate. Anything below 1.0 usually screams that a stock is undervalued compared to how fast it's growing. PJT's PEG ratio is sitting at an incredibly low 0.51. So yeah, you might be paying a high multiple today, but the company's earnings are growing so fast that the price is actually kind of a steal relative to that growth.
And to really wrap our heads around why that growth is so explosive, we have to look at the ultimate truth teller in all of finance. You see, companies can massage earnings with clever accounting, but you cannot fake cold hard cash. We need to talk about their free cash flow.
Just look at the massive disconnect here. We've got a free cash flow yield approaching 12% compared to an earnings yield of barely 4.5%. Normally, you'd expect these two numbers to be pretty close to each other. The fact that their free cash flow yield is just towering over their earnings yield means this company is pulling in way more actual physical cash than their baseline accounting income suggests. They are a literal cash machine.
Let's put some actual dollars and cents to that so it clicks. Over the trailing 12 months, their official net income was about $180 million. Okay, not bad. But their free cash flow? $480.4 million. They literally brought in $300 million more in pure cash than their net income let on. And when you have almost $500 million in cash flooding into a debt-free business, you get that final crazy stat, an 81% earnings per share growth rate over the last year. That right there, that's the engine driving that incredibly low PEG ratio we just talked about.
Okay, we've stared down the terrifying surface-level multiples, we've marveled at the pristine zero-debt balance sheet, and we've unpacked the explosive cash flow. Now it's time for the main event of this explainer. We need to finally answer our opening question. Is this stock a trap or a gem? Let's run the final valuation verdict. We can actually walk right through the math on this. Let's say you bought a share today for $156. Well, when we plug their baseline future earnings into a standard discounted cash flow model, it spits out a fair value price of $188. So right off the bat, the math is telling us the stock is trading essentially $30 below what it's intrinsically worth.
But wait, remember that massive $480 million in free cash flow we highlighted a minute ago? Well, if you run a fair value model based strictly on that pure cash generation, the fair value price explodes to a totally jaw-dropping $575. Now look, is the stock going to magically hit $575 tomorrow? No, of course not. But this number just perfectly highlights the extreme theoretical upside that's currently embedded in this company.
And hey, even if we completely ignore that massive $575 cash flow target and just play it super safe with the baseline earnings model, the data still gives us a margin of safety of nearly 17%. That means even with really conservative estimates, you've got a 17% cushion between what the stock is actually worth and what you pay for it today. It completely confirms that the stock is undervalued, totally shattering the illusion of those scary multiples we saw at the very beginning.
So that leaves us right back here, when a company with literally zero debt, an absurd 58% return on equity, and absolutely massive free cash flow generation suddenly goes on a 20% sale? What do you think? Value trap or hidden gem? The data we've walked through today makes a seriously compelling case that looking past the basic, surface-level numbers is exactly how you uncover incredible businesses hiding right in plain sight. I really hope this deep dive into PJT's metrics sparks some new ideas for you. Thanks so much for hanging out with me for this explainer, and as always, keep exploring the numbers.